Welcome back TMT traders to another weekly outlook video. There's plenty to go over, so let's just go right ahead and dive in. So let's come from last week and just recap what happened fundamentally and how did things react in the market based on what happened. So we started out the week with the RBA rate statement. The Australian dollar basically sold off, but not to an extent as where it could end up if this economic struggle that the Australian dollar and the economy finds itself in continues. So also we had two data points from the Australian economy: the GDP decline on a quarter-on-quarter basis, and the retail sales on the Australian dollar as well. Now, China's economic slowdown is going to affect the Australian economy as well. We are nowhere near at a point where the Australian economy would come out and the RBA would come out to slash growth outlooks or to even consider cutting rates. We've had some chatter about cutting rates, but we're not really there yet. However, if this is something that continues, we might see the Australian dollar continue to the downside, not necessarily on the Aussie dollar against the US dollar, but also against other crosses as well, such as the Aussie New Zealand. You can already see here on the weekly and the daily that the Australian dollar has been declining against the New Zealand. So the takeaway from this is to watch the Australian dollar for any retracements. If those retracements are not supported by positive data points from our economic calendar, and they end up in a lower high and a technical lower high on the charts, then we should be looking to sell into the Australian dollar, at least for the time being, until new data emerges. Next up, we had the Bank of Canada rate statement and monetary policy meeting. Again, they're staying put on their current policy, not really looking to change anything, but there is a weakening with coming from the Canadian, and we could see the Canadian dollar weakening across the board, especially on the US dollar Canadian as well, and other Canadian crosses, which we'll go into. So you can see the 133 has been broken above on this US dollar Canadian, and we can't really say that the dollar itself is strong enough to would have taken over this pair to drive it to the upside. So this was a very almost equal measure of, even if not tilted to the Canadian dollar side, the weakness that came through from the Canadian dollar to make this pair rally to the upside. Now the IVPMI, which is the manager's purchase index, also declined just above the 50 level, so it had a level around 54 and it declined down to 50. Now you have to remember these index figures when they come in from the economy and when they post these figures. Anything above 50 is regarded as expansion, and anything below 50 is regarded as contraction. So on the dot, on the 50 line, it's really, especially if it's coming from a high, it is not seen by investors as something positive towards the outlook of an economy, and it's certainly not the case in the Canadian economy in this case. Moving on to the euro, again, not a nice picture here that the euro painted for last week. We could see the euro tumbling against a basket of currencies. So basically, if you look through euro Aussie, euro Canadian, New Zealand yen, everywhere you look through, there's red on the euro, and for very good reason. So the EU Eurozone, the ECB, and the central bank, they just ended quantitative easing. QE is sort of, this was back in December, 3 months before, and QE is what the central banks do in order to basically have a stimulant for the economy and to keep borrowing costs low, and also to keep inflation in check in case there's still low inflation. So it's sort of like saving the economy from going basically bust. And that QE was ended on the sides of growth outlook, improved growth outlook for the 2019 year. And just 3 months in, the ECB went ahead and downgraded their outlook from the 1.7% growth outlook down to the 1.1. That's a 0.6% downgrade. And within 3 months, within the new year, it is a very severe downgrade. And at the same time, they also mentioned that they will be injecting money back into the economy, as I said, just 3 months after ending it. So it's not a good sign, and we can definitely expect extended euro downside. Again, similar to what I said on the Aussie, we have to remember that the Aussie does have a 1.5% interest rates, whereas the euro has a 0.1. So again, if we would pair the two of them up, the euro is much weaker than the Aussie at this point. But the same sort of strategy applies. So if we don't have any data, if we see any retraces and see any buybacks, any rallies, bullish patterns on the euro, we have to assess whether it's the euro's doing or not. And if it's the euro's doing and there's no economic data point that would support that rally, then basically a lower high is the next best thing we can look at to sell into the euro. Now, my only concern with this is that we are quite extended, right? So we're quite extended on the euro against the dollar. That's why it is the benchmark that we look at, the euro against the dollar, because it's one of the major pairs. But it might be a better case in our scenario to look for something such as the euro Aussie. As I said, both of them are weak, but overall the euro is weaker. Euro Canadian and even euro New Zealand. So these are pairs that have seen euro weakness, but they are not as extended as the euro dollar, for instance. Even euro yen is not as extended as of right now. Just keep in mind that when we talk about the euro or the dollar as a major pair, it doesn't necessarily mean that the current outlook and what we expect for the pair to do, whether to strengthen or weaken, is against another major currency. It's usually another currency which it might not be as apparent at first, which is why we have to look through all of the 27 major pairs and to compare the correlation between them and see which one represents a better value to sell or buy from. So moving on, let's close with the US dollar. We closed the week with the US dollar and we had the NFP unemployment rate and average hourly earnings. Now, very interesting and mixed data on this one as well. If we look on the DXY index, we could actually see the dollar strengthening. It's a bit of a inverse reaction, but at the same time, it could be supported. I'm not saying should, but it definitely could be supported if every other major currency that we talked about remains weak, and the dollar itself will be the only one that's going to slightly lead ahead, still being weak, but it'll still lead compared to the other ones. So the NFP headline non-farm payroll came in at 20K. That's a very, very low figure, as in jobs added to the economy for the month of February. The previous was 310K and it was expected at 180. So 20K is a very, very low number, but it was offset by the unemployment rate, which improved from 4% down to 3.8. That is a good number. And average hourly earnings also improved up to 0.4% from the 0.1, the previous one. So it is a mixed data point. So overall, that NFP number should have dragged the currency down, but on the horizon of the next 4 weeks or even until the next NFPs, those unemployment rate numbers as well as average hourly earnings is something that clearly improved, which wasn't expected. So in that case, we could see the dollar pulling further to the upside, not necessarily because it's very strong on its own, or the US economy is as strong as we expected it in 2019, especially in the first 3 months, but it's still stronger than the rest of them, which have drastically seen some growth and now they are being downgraded. See the case of the euro, see the case of the Aussie that I mentioned previously. Now, based on this, let's see what we can expect for next week. Well, there's a couple of things. We want to see if there will be any technical movements on last week's moves. So we had Australian dollar, Bank of Canada, which means Canadian dollar, euro, and dollar, right? So US dollar. So Australian dollar, US dollar, euro, and Canadian dollar. Any sort of technical plays, technical setups that will show on the charts on any of the pairs that feature one of these will be a good one to keep an eye on. So going forward next week, we can expect dollar retail sales and inflation numbers. Both of these again are expected to either stay the same as the previous, which is again, if something is staying the same as the previous number, it means that it's not weakening. And in the contrast of the other major pairs, major currencies weakening, it's going to be seen as strength. So this is the case of the retail sales on the US, which is expected at 0.2% next week, and then the inflation numbers, which again are expected to improve. Now, if this holds up, if this data point holds up, we will see the dollar strengthening further. And again, based on this calculation, pairs such as the dollar Canadian, pairs such as the dollar yen, are pairs that we can look at to see if this dollar strength continues. Two things that these two pairs offer, they are one of the two major ones, but at the same time, for instance, if you look at dollar yen for right now, at 112 level, we've seen some resistance and we are selling back just slightly to somewhat of a value at around the 111. Now 110.50 would be a really good value to buy back from. Obviously, just because these numbers from the US will come in improved, if they do, it doesn't mean that we should blindly buy the dollar because it's going to be weak, end of story, and we should just buy it. No, we still have to wait for those retracements and wait for those candle patterns and technical confluence in order for us to get in. But knowing full well that we have the support of the fundamental figures, we shall be much more confident in taking these trades as soon as technicals show. So these two, for instance, dollar Canadian, dollar yen, dollar Canadian as well, if we have a retracement down to the 133 level, which is the previous breakout price and previous breakout, we should see some nice opportunities aligning there. Next up, the currency that's worth mentioning, although I wouldn't recommend trading it, and I'm certainly not going to trade it. It would need to have very, very textbook clear technicals for me to trade it, and there's just no way and there's no case that would happen, is the pound. And even if it does happen, the fundamentals, again, they would offset it at a very crucial time and uncertain time in order for us to be able to stay in a trade even 12 hours at this point, even half a day. And the reason for that is because first up, we have on Tuesday we have two major things. One of them is the GDP on the UK economy alongside manufacturing numbers, which in and of itself, if we wouldn't have any sort of other fundamental figures or anything out, this alone could make or break a trade in case they either improve or weaken too much. But at the same time, we have the Brexit deadline vote. So this is on the 12th of March on Tuesday, and again, what we can expect. This was the vote that should have happened last week, but it was pushed towards this week in order for the UK Parliament and Theresa May, the Prime Minister, to be able to adjust and to have more time to negotiate a deal with the Eurozone. Now the Eurozone had its own problems now economically, and now Brexit is still in the limelight there. So it's not going to be an easy task, and right now there's no news that any changes have been made to that negotiation, which means that as of right now, we can be 90% sure that the UK Parliament will reject the current deal, and they will either go for there's three scenarios really. A no deal scenario, which would mean that the UK is exiting the EU on the 29th of March with a no deal scenario, and there will be new policies put in place which no one knows what they are, which is really the scariest outlook and mostly feared by a lot of big corporate and businesses throughout the UK and the Eurozone as well. The second is a delayed deadline, which means 3 months, 6 months, a year, no one knows. So Brexit deadline, exit basically being delayed to allow for more time to negotiate between the Eurozone and the UK. And the other two, one which is really the branch of the extension, so the extended delay has two outcomes really. What would happen? One of them is try and negotiate another deal, And the other one, which is Labour Party is backing right now, is a second referendum, which is still on the cards, and still something that we could see headlines popping these out. So again, there's no clear way to know what will happen, but the fear mongering is very much alive, not just in Parliament, but also with investors, and what should they expect. So the Prime Minister, basically, one headline read, which I find very interesting. The Prime Minister Theresa May said to Parliament that if they don't accept her deal on this Tuesday, which is very much likely that they won't, but if they don't, then there's no way to know what will happen with Brexit and the UK, and it will be on the shoulders of those who oppose the deal to basically suffer the consequences, because there might not be a Brexit at all at that point, or there might be a delay. She might be stepping down as PM, so there's a lot of things going on. So that's why I said we shouldn't really get into, because it gets really, really complex. However, the point to take away is that if you see a very good technical setup on the pound on any of the crosses, you might want to hold on for this week. And mind you, we might get that good technical setup, and it might even work out. But do we want the added risk of the uncertainty of not knowing, having the confidence technically, but having basically a very clear factor in which our trade, even though in profit, could just go to the other side and take us out for a loss? We don't really want that at this point. There's no reason for us to take that risk into factor. Now moving on, the next set of data is the Chinese data, and again, not really going to go into too much in detail with this. Very rarely do I trade the Chinese currency. However, in this case, it'll have an effect when it comes to the Australian dollar. So the Australian economy can suffer further if there's no the Chinese outlook is downgraded, or the Chinese numbers are not improved enough. Then it means that the trade with the Australian economy is not going to be as high, bringing less into the Australian economy, as in money inflows, and at that point, again, the Australian dollar will weaken further. So Chinese data is always linked to the Australian dollar, and even the New Zealand one at some points. Now to close is the Bank of Japan's monetary policy statement. And so again, not expecting to have a change there, but going by the current rhetoric of what we could see, and the global shift back to a downside movement instead of the improvement outlook, which was the case at the end of the last year. We expect the Japanese monetary policy to stay the same. I don't see how they wouldn't go into QE right away. They might signal it, but really the point to take away here is that if dollar is uncertain, euro, pound is uncertain, Canadian is downgraded, and if we have the majors really coming in and having weakness throughout the currencies and throughout the pairs, then usually what will happen is that investors will look for safe haven inflows. And the Japanese yen will go into a mini lesson one of these weeks why the Japanese yen is a safe haven inflow, considered a safe haven amongst investors. But we could see, despite the Japanese economy not improving for any major reason, we could see the Japanese yen strengthening across the board, simply because traders and investors are taking their money out of any other assets that are uncertain and putting it into the Japanese yen. And so it was the case on the Canadian yen and the Aussie yen, which were two trades that I took. And if you please check out the weekly newsletter, there's a clear technical breakdown and technical review of how I managed this trade, how I got in, where did I got in, how to do a smart stop placement, and so on and so forth. So make sure you check out that newsletter, because it'll be there fully explaining how I took these trades. But these, both of them, when we look at the fundamental perspective, they were based on Canadian weakness, Aussie weakness, as well as some Japanese yen strength. And that strength could have been the early signs of safe haven inflows that are about to follow in case more weakness occurs in the major economies. And so that's really what we can expect for next week. Make sure you look at those technical setups and always align them with what is the calendar and the actual figures are showing. And have a great trading week, and I shall catch you on the inside. Cheers for now.